Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 8th of June. Let's dive into the week's top market news. Navigating the European maze, trade headwinds, regional contractions, and the electric velocity. European markets are currently struggling to find a clear sense of direction as investors actively digest a complex cocktail of macroeconomic adjustments, geopolitical developments, and shifting trade policies. The Pan-European Stocks Europe 600 index recently logged a decline of 0.53% in local currency terms. This directionless trading reflects a market caught between micro-glimmers of hope, such as the likelihood of successful US-Iran negotiations and a possible ceasefire between Israel and Lebanon, and structural anxieties sparked by the Trump administration's announcement of upcoming tariffs of 10% to 12.5% on a broad swath of nations. The regional fallout was highly asymmetrical. Germany's trade-reliant DAX felt the pressure sharply, closing 1.38% lower, while Italy's FTSE/MIB fell 0.29%, and the UK's FTSE 100 index slipped 0.40%. On the other hand, France's CAC 40 index managed to counter the broader trend, closing up by 0.43%. Compounding this market unease is the latest hard data from Eurostat, which confirmed that the euro area economy contracted by 0.2% in the first quarter. This final reading marked a disappointing downward revision from initial market estimates, which had originally pegged gross domestic product growth at a positive 0.1%. The localized impact varied wildly across borders, with the sharpest economic contraction recorded in Ireland, where the economy shrank by a staggering 12.1%. This structural weakness quickly translated to the high street, as Eurozone retail sales volumes dropped 0.4% sequentially in April. This contraction was led primarily by non-food products and came in worse than the consensus estimate, which had anticipated a milder 0.3% dip. Nationally, consumer retrenchment was evident in Spain, where retail trade fell by 1.5%, and in Germany, which saw a 0.2% drop. France, however, once again signaled resilience as its retail sales volumes expanded by 0.3%. Defying the overarching Eurozone slowdown, manufacturing and trade diagnostics from France offered a bit of positive noise, as industrial output edged up 0.1% month-over-month in April, comfortably beating the expected 0.2% contraction. The subtle expansion was primarily propelled by manufacturing gains in transport equipment alongside coke and refined petroleum products. This underlying industrial engine, paired with robust exports of transport, mechanical, electrical, and electronic equipment, ultimately helped France successfully narrow its trade deficit for the month. Meanwhile, the United Kingdom's automotive segment delivered an incredibly robust performance that hints at a profound structural evolution. Data from the Society of Motor Manufacturers and Traders indicated that new car sales surged by 7.1% year-over-year in May 2026, marking the highest statistical achievement for the month since 2019. Crucially, this growth curve was entirely driven by the rapid acceleration of the green mobility shift. Traditional internal combustion platforms saw a clear decline, with petrol registrations dropping 7.1% and diesel falling 2.2%. In stark contrast, plug-in hybrid sales experienced a massive surge of 23.9%, while battery electric vehicle registrations led the charge with a spectacular 34.2% climb. For long-term market strategists, It is clear that while macroeconomic winds remain highly erratic, structural pivots like the electrification of transport are carving out unstoppable momentum of their own. Now our insight into alternative markets. Private equity at a crossroads, liquidity pressure, declining IRR, and the growing importance of manager selection. The private equity market is undergoing a phase of deep structural transformation, characterized by a progressive lengthening of asset holding periods, which today average nearly 7 years compared to fewer than 4 in the past. This phenomenon penalizes the liquidity actually distributed to investors, DPI, forcing fund managers to resort to alternative strategies and financing channels to generate cash flows, such as NAV financing facilities secured against the fund's net asset value, dividend recapitalizations, and continuation vehicles. The effects of persistently low distribution rates are creating a far more competitive and complex fundraising environment, reducing the share of financial resources that institutional investors can readily unlock and redeploy into the same asset class. An analysis of different vintages reveals that funds launched between 2019 and 2022 show a marked decline in performance from their fourth year onward, reflecting the dramatic shift from the valuation peaks of 2021 to the sharp slowdown in exit activity that has persisted since 2022. Whereas historically the DPI multiple tended to reach parity, 1x, around the fifth year, current data indicate that the median across all private equity strategies sits below this threshold even at the 8th year from launch. Even buyout funds, traditionally faster at executing exits compared to segments such as venture capital and growth equity, are barely managing to exceed the parity threshold by the 8th year, precisely due to prolonged portfolio company holding periods. At the same time, the internal rate of return, IRR, once considered the gold standard metric for evaluating investment success, began showing signs of structural deterioration as early as 2017 for overall strategies and 2018 for buyout funds specifically. After a near vertical surge in 2021, driven primarily by the explosion in technology sector valuations, the IRR suffered an equally sharp reversal beginning in 2023. In this highly volatile macroeconomic environment, manager selection proves to be an absolutely critical factor for total value to paid-in capital, TVPI, outcomes. First quartile funds are able to double the median performance by the 8th year, while bottom quartile funds see their value growth stall almost entirely as early as the 3rd or 4th year. On the geographic front, however, there is one positive note. Pre-2022 Europe-focused funds have progressively outperformed other global regions in terms of distributions, benefiting from an acceleration in deal activity that began in 2017.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.